Let's kick off today's session, which is going to be in two parts. It's going to start with me, then I'll hand over to Jeff, and no doubt we'll bounce around on the Q&A towards the end of the session. And what we're going to do today is have a look at meaningful patterns that we can discern within the footprint chart and how we can distinguish useful stuff from all the noise. And one of the things, of course, with the footprint is you've got all these numbers which are in there. And like lots of stuff on charts, we actually have to get rid of probably 90–95% of the information and just get to what's important. So I'm going to go through my kind of go-tos, which are in there, and I'll give you the rationale behind what these patterns are and, to a degree, how we can act on them. As normal, this is for educational purposes only. All this stuff is at your own risk. Take everything that you're hearing with the relevant pinch of salt and use your own judgment. And as I said, the agenda is going to be, I'll go through the tools in my toolbox, Jeff will do his, and then we'll interact for some Q&A. So let me frame this by talking about my approach to setups. Although I do scalp, I tend to do more swing trading during the day. And that's partly because I will scalp the open if things are hotting up, or, I will scalp during a swing. But I like to organize my trading into certain time-based setups. So I know that at certain times during the day, I know what I'm looking for. And if I'm able to execute on that trade, I can do it. I've had the experience of being in a prop firm where I was staring at a screen for 6–7 hours a day. And, well, in part it got dull, but also I don't want to spend that long on the screen. I would rather be spending my time researching setups, researching how stuff that I see can turn into indicators or algos or things like that. But I still do trade manually and discretionarily in order to see what's going on. And that's, it's my preferred style. It suits my personality. And with that in mind, the way in which I always build my setups, I liken the process to archery or firing a gun. So I always want to have a planned exit. I want to trade towards a particular target. We know it's important, know where you're going to be wrong. But so many traders, especially new TA traders, they'll pull up any price chart, their magic indicator goes green, 2 EMAs cross, whatever, and they enter. But they haven't given a thought of where they're going to exit if the trade's successful. They might go, "I'll take profit 20, stop loss 10." Well, great, you're going to lose money. And then they go, "Okay, I'll have a wider stop than my target because I'm a scalper." They still lose money. And to my mind, of course, you've got to know where you're going to get out if you're wrong, but it's good to have a plan of where you're going towards. I like to think of this as well, that just because a train arrives at the station, you don't jump on it. You're getting on a train because you've got a plan to go somewhere. So all of my setups, which we're going to start to go through in later sessions, are really predicated on the idea we are going somewhere. So the first thing I do in my setups is I locate my target. I take aim. Then I draw back the bow, or I cock the hammer of the pistol. So I am looking for favorable order flow, and I'm analyzing patterns within the footprint in order to do that. So just because I've found an opportunity to trade towards somewhere, I don't dive straight in. I want to see conditions start to align themselves in order to consider taking the trade. And we'll spend most of our time today looking at these patterns. But just because a pattern appears, that doesn't get me in either. I'm looking to release the string of a bow or pull the trigger on the pistol. So I'm also looking for an entry trigger. I'm going to allude to some of this today, and we'll look at some coarse entry triggers. But several of the triggers I use are too fine to work out in using mental arithmetic, and I tend to try to automate a lot of my entry triggers, and I'll explain this in more detail as we get there. So I've really got a three-phase approach to my setups. Work out where I'm going. Do the conditions look right to consider going there? And finally, pull the trigger. And you can probably get a sense, this is almost like different time frames. I'm looking at market structure for a target. I'm looking at order flow in the now in order to consider entering the trade. And then right now, maybe on liquidity or on changes to the pattern of the order flow, that's when I'll actually enter. And it might be an automated entry, it might be me entering a market, that kind of thing. So it's very, multi-time frame, considered process of how are we going to deal with this trade. And I will take two types of trade. I'm either looking for the direction of price to reverse, so I want to go back from where we came, or I'm looking for the direction of price to continue, which might keep me in a trade, or I'm looking to trade a pullback effectively. And there aren't any other sides of trade. We're either reversing or we're continuing. So I'm sharing this so you get a sense of the approach to my setups, and then you can really start to frame how and why I'm reading the patterns in the footprint as I am. So the first pattern, and this is really one of my main go-tos, it's a pattern that I call price rejector. I got this nomenclature actually from Mike Valtos of orderflows.com 4 or 5 years ago. I think the pattern in turn, he may well have been looking at this pattern. I can recall from 5 or 6 years ago, NOFT, Ninja Order Flow Traders, Kai Whitney, referring to a pattern called sequential decline. So that may have been the first public airing of the concept. Mike will certainly have been using it for years around that time, even earlier. And then when I productized it at Emoji, I called it price rejector, and we've since enhanced it quite a lot from Mike's original ideas. But you don't need an indicator in order to see it. The idea of the price rejector is we are combining multiple situations in the order flow. So here we've got a price rejector. Oh, my mouse is misbehaving. Here we go. We've got a price rejector at the top of this candle. So we can see at higher prices, we're experiencing exhaustion, 77, 72, 2. As prices going up, we've got less aggressive buying going on. We can also see it's completed auction. We've got a zero print on the bid. We've also got an imbalance in the opposing direction. So at higher prices, we're running out of buyers. The auction's finished. We've got aggressive sellers entering the market, pushing us back the other way. So we're combining exhaustion with aggression. That's the basics of the price rejector. I tend to finesse it a little bit more. I also consider the absorption. So I want to see positive delta through the area of the exhaustion. So I know that the aggressive buying is being consistently met by passive selling. And you can finesse this a bit. You can decide, do I want to see consistent absorption at each price level where we're experiencing the exhaustion? Do I maybe only want to see an aggregate of the exhaustion? So if the delta on these 3 prices is positive, so let's imagine this 36, maybe that 36 was -2. I'd still net have positive delta to those 3 prices. So this can be finessed. The imbalance, of course, whatever percentage you put in is wrong. This is probably set at 400%, could be 300, could be 600. So these are all degrees of filtering. But the principle is we're looking at the edge of a rotation for a combination of exhaustion, aggression in the opposing direction, and absorption. And these are the building blocks of everything that's going on in the order flow. So it's a reasonable premise to think that if we are seeing all of these conditions at the same time, we are reasonably well placed to go back the other way. Now, what I find is it's important to have precision within this pattern. I've seen enough times that, let's imagine we've got 2 imbalances here, if that 42 is an imbalance because of low volume on 72, or if that was maybe 4,000. When the pattern isn't this clean and we have got multiple imbalances, actually it ends up not working. So I find it has to be very accurate that we've got the imbalance only in the one price off the extreme price, and then it seems more reliable. But we've still got to qualify it in terms of context as to where we are. You don't just trade it because it's a pattern that's occurred. You have to have a reason for trading it. Is it at a structural level? Does it support your trade idea in terms of going somewhere down here? And it's also important to consider the behavior of delta. So in its basic form, this price rejector pattern is a sign of reversal. but I do consider it more at an inflection point, or if I have established a target somewhere down here, then I'm looking for this as an opportunity to get in short to go back down here. Now, I like to use changes in the delta on the way down on the pullback, and we covered pullback in the last clinic. I like to consider how many contracts have been absorbed. So here we've got 35 plus 36 plus 2, 73 contracts were absorbed through this area of price rejection. Now, I then consider, as we're on our way back down, I know we've got 72 contracts which are offside, and I will then track the delta of when we pull back and use this as a potential entry trigger. So if we're still bouncing around in here, in other words, we're auctioning down here in the pullback, if I'm seeing positive delta in here, then actually I figure the pattern isn't going to work out, and I absolutely won't go short. I may even enter along because we've got this kind of temporary exhaustion, but for as long as we're positive delta on the way back down, I've got no reason at all to think that a short trade is going to work out. But I do like to consider, well, how much of these contracts which are offside are puking on the way back down? Now, obviously, as the delta here is reducing, it's going to have a knock-on effect of these 73 contracts which are offside. So the negative 18 here on this level, when we were at the top price here, we'd have had 73 plus 18, which is, come on brain, that's going to be 91 contracts were offside in the pattern. The negative 18 has reduced it to 73. So I'm looking at the ratio of the pullback versus what's offside, and you can start to play with, well, if half of them have puked, then maybe I'll enter, or do I want to see everybody puked, which in reality means you're probably going to be somewhere down here until you enter, but that could have taken the energy out of it. But you can start to really finesse the trigger. So I'm using the delta as the trigger on this pattern for your entry timing. And as Jeff always says, good trades work out quickly. If you just see this pattern, you enter short, because, I've got a pattern, let's enter short, it's going to churn for a bit. You may get a losing trade. If you start to assess what's going on, now that I can see the pattern in the order flow, and how is the trading on our way back down from this going on, that's how you can start to optimize your entry. Other things I will do, but I do this through automation, is I will consider how many contracts are offside, and I'll consider, based upon the liquidity in the book, if these 73 contracts puked, how far through the book will it take me? If they won't even get me through one price level, I'm not interested. But if liquidity thins and it'll take me through 5 price levels, in other words, more than the pattern here, I get really interested, because a lot of big volume traders are going to suppress movement of the market by having liquidity in the book. But when they've fulfilled their objective of loading up short in this case, they'll pull the liquidity on the buy side. Now, you really can't calculate this manually, but I have like prototype bots which are looking at the delta versus the price levels in the book. And if we suddenly change, and I'm happy to go in just as the liquidity is thinning. But this is getting quite advanced and probably too much for today's session. But the key point is, start to tune your eye to this combination of exhaustion, opposing aggression, potentially delta, supporting absorption, and you see this more and more. I've already mentioned the importance of there being precision in the pattern. If it's not perfect and we've got 2 imbalances rather than 1, or imbalances on the other side, it doesn't qualify as the pattern. We can also use this as a continuation signal. So here, here, come on Zoom, let me do this. Okay. So what I've got is, here's our main candlestick and here's the pullback. So this is the auction within the auction. This time frame is wrong. It happens to be a 1-minute candle. I don't really care. But this is showing me what's traded since we've come down from the high price. We do happen to have a price rejected pattern at the top. I'm disregarding that. You know, for whatever reason, I've got an interest in a long trade. I want to get long at some point during the formation of this candle. So this candle's come off its high. This is the volume that's traded down. And you can see within the pullback at the bottom, we've got the same pattern. We've got decreasing volume hitting the bid, 373, 244.7. We've got an imbalance in the other direction on the way up. We don't have negative delta. I get a little bit less fussy on looking at the absorption as we pull back. But this shows how we can also use this pattern as a continuation signal as we're coming off the high. And in reality, on a squiggly line chart, I'm going up, I'm pulling back, I'm going up, I'm pulling back, I'm going up, I'm pulling back. So if this 1 minute candle was a 5-second candle, we'd have a zigzag moving up. And all I'm doing is buying the dip based upon the order flow when we pull back. So we can look at it at reversal, but a reversal may well be somewhere intra-bar because we can see the volume that's intra-bar by evaluating the pullback. Actually, David has just said, even after last week's video, where we were looking at absorption, exhaustion, he struggles seeing it. Well, you know what? You have to spend a lot of time looking at footprints, looking at deltas, and looking for these patterns of exhaustion. So reducing sequences of numbers and looking at the polarity, the positive or negative of delta. And with enough time looking at it, you see it. But it's important, first of all, get those concepts embedded, and it's practice, practice, practice. And then you're able just to glance at a footprint and you can understand the story of what's going on. So that's the price rejector, which really is one of my go-tos because it's encapsulating so much favorable order flow conditions that imply a reversal. Jerry says, can this be seen by the pullback delta for price? I don't understand that question, Jerry. Can you rephrase that in a clearer way, please? The question feels backwards as I'm reading it. So Philippe's saying it's cool to have the footprint only of the pullback. Absolutely. For me, the pullback is a really powerful feature. On Ninja, I know that AMS Delta prints do that. I don't know about MZPAC. In Sierra, it's there, and I find it incredibly useful. Plus, interpreting the delta of the pullbacks. So this -20 is the delta of this pullback column. I find that useful as well. So here, even though I'm not looking at the delta, I'm looking at this. I would hope to see the delta of this candle go positive before I look to enter long. Okay, so Jerry is saying, let's say we test the high, yep, and we are looking at the pullback delta from that point. Can we identify this by the positive or negative delta? No, there's not enough information there, Jerry. This pullback delta is useful. So if we're coming off the high and we're bouncing around here and we start to turn up, then as we start to get positive delta, that's good. We know that the auction within the auction is showing more aggressive buying, but you can't qualify whether we've got exhaustion and aggression in the other direction and potentially absorption on this volume on the way down just by looking at the delta. The delta is a really coarse aggregation of all of the delta at price through this mini candlestick. So it's giving us more information than just price, but it's not telling us the nature of the trading at every level, or if the low extreme of this really feels like a low extreme. Okay, so that's price rejector. Next thing I look at is absorption. And recall, in order to identify absorption, in other words, when the limit orders have overwhelmed the aggressive market orders, we consider the delta at price. And what I'm interested in is where have we got significant levels of delta at price, and where are we trading relative to it? So here I've considered the platform to highlight the largest positive value of delta in the candle, which happened to be 511 here, and the largest negative, which was negative 1196. Now, negative 1196 versus negative 1192, they're the same. So that's why I also have a profile of delta at price here. And I'm using very long time frames. I like to use a 30-minute candlestick. But I'm interested in if we have got significant delta at a contextually significant place. So here, one tick off the high was the maximum positive delta. Its absorption at the extreme of the bar. That's pretty significant. It's also important to understand on the product that you're trading and on the time frame, the candles that you're trading, how much volume being absorbed is significant. Now, typically at the edge in ES, anything 400, 500 contracts upwards is significant. You will find days where it will get to the first hour high or low, or reach the low of the day, and there's frenzy of activity, and 1,500, 2,000, 2,500 contracts are absorbed, sometimes even at the most extreme price. This is really significant. This represents kind of stopping volume, and we will quickly go the other way. But it's important to review the product that you trade and start to understand how much volume is significant when we're at an extreme. So here, this for me at 8:30, we've done our first rotation on the TPO. We closed way below it. At this point in time, at the close of the first 30 minutes, I'm having a sense that this high is quite secure. Now, look what happens in the next 30-minute rotation. We opened, we went up. Where did we go up to? We went up to exactly that price level. That can only be a coincidence. I can't think of any reason. Oh no, order flow, that's why it happened. But we established in the first 30 minutes of trading, this was the price where passive sellers were extremely happy to sell to eager buyers. It was retested during the second 30-minute rotation. And as we're looking for asymmetrical trade opportunities, as we opened and we got back up here, and for me, I'm always considering during each trading period that I'm interested in, where are the passive traders sitting? So I would have been watching this level after the first 30 minutes to see what was going on here. And, I could have traded it blindly. I had good asymmetry. But if we start to see what's going on and we get up here, I've got positive delta absorbing on the way back down, which look, we have an imbalance. It's aggressive on the way back down. You can also start to sense this is pretty good. What we can also do, if we crunch the volumes together, so if I was looking at a footprint of the whole session, then 527 plus 83 is, 610 contracts. 1,260 plus 719 is, come on brain, is 2,000 odd. We would have had exhaustion, even though we don't see exhaustion here. Sorry, we do see exhaustion here, but it would have been confirmed on the overall volume for the session, even though we don't see the exhaustion from 793, 1260, 83. On aggregate, and that's why I look at the session footprint as well, as we went back up here during the second rotation, the top of the session would have been exhausting and confirmed by where the maximum positive delta was during that first rotation. Naresh has asked, is that a weak high on order flow? Well, weak high is a market profile term typically relating to a double print. Double print or lack of a tail. I think that's just a coarse way of saying what we're seeing. In reality, we know it's weak because there's all this absorption, and we couldn't get higher, and we've exhausted in aggregate on the way up, and we've aggressively coming down. A TPO trader will look at it on their market profile pattern and say, oh, it's a weak high. We understand why it's a weak high and therefore what to do with it, and we can assess that as it's happening from the volume. The profile trader is probably going to have to wait until the close of this second B period until they can make that assessment. So absorption is interesting based upon its location and its size. And just as with the price rejector, we can evaluate it in the pullbacks as well. So when I'm trading, looking at the pullback volume within a given rotation, I'm also assessing where is the biggest positive, where's the biggest negative delta, to have a sense of how things are absorbing on the pullback from the extreme of the candle. Okay, next pattern, unfinished business. Well, we did a whole clinic on this, and I'm referencing it here purely because it is one of my go-to patterns within the order flow. So I am very interested in unfinished business at extremes of the session, and I will qualify it whether it's a trade away or whether we're likely to go back there. So the key point is, if we are exhausting, if I've got less volume at the unfinished business price than what's there before, I know we've just run out of buying momentum, buying impetus. If we see this the other way around, then I figure it's absorption, and actually we've got strong passive traders coming in. Jeff is asking if I can comment on unfinished business in last week's action. I think let's do this once we get through the deck, Jeff, and maybe I'll bring up my platform and we'll see, we'll go through some 30-minute charts and have a look at what's what. Now, what I've got here, this is on the 30-minute chart. We've got unfinished business at the top of the A period rotation in the first 30 minutes. And this is a really great example of a setup. Now, what I'm interested to know, and put your answers in the chat box, can anybody see the trade opportunity just based upon these two footprints? So I'll give you a couple of moments to... Okay, Jerry Cat. Yes is not an answer, Jerry. Philippa said unfinished business and pullback. Well, I don't have the pullback column displayed here. All I've got here is a 30-minute footprint starting at 8:30 and a 30-minute footprint starting at 9 o'clock. So give it another couple of moments for anyone to refine their answers or put in anything new that they see. Unfinished business on the left, finished business on the right bottom. Yeah, that's quite good, Darren. High negative delta, no, two course no edge. Absorption unfinished business for pullback minus 946. What? I don't know where you got the 946. Okay, I'm intrigued by that. Right, oh, we're not quite getting there. Trade towards the unfinished business, yeah, that's the setup, but the reason we get there, we have our price rejector pattern at the bottom of the B period candle. I'm just interested to see who is in the webinar. Anita, Anita, you have to stand in the corner. I thought you'd have got that one. We've been through this, and it's a classic setup that we do. So here's the setup. It's typical for me, inside out, or trade towards setup. We've got unfinished business at the session high, and I'm looking at 30-minute candles here. I'm looking at very structural stuff. In B periods, we opened, we will have gone down, and we will have gone up, because this is an up candle. So it opened, rotated down, rotated up. At the bottom of its rotation, we have exhaustion, 598, 420, 34. We've got aggression in the opposite direction. We've got a price rejector. We've got negative delta through those three prices. Now that negative delta was, how many contracts is that? Minus 209, less another 187 is about 400 lots negative. So this gives me the target, yeah? I'm taking aim with my archery bow. This is having me pull back the bow. Where's my trigger to enter? Well, my eye is drawn to this strong negative delta, because as long as we're above this, the passive buyers are winning. Yeah, so on our way back up out of this price rejector, if we're hovering around here, I'm interested to enter. If I calculate up the deltas once we get beyond here, this was actually the inflection point. On the candle on the way down, the pullback delta will have, at this point, told us everyone who is offside here will have puked. So that for me is a little bit too late to go in versus the immediate target to go here. But just based on context, knowing that the B period will generally reach the extreme of the A period many times during the day, if I know I've got unfinished business at the edge of the first half hour and I've got a nice pattern in the order flow, I'm really opening my eyes and getting ready to pull the trigger because I've got my target. I'm cocking the hammer, I'm pulling back the bow, and then I'm just looking for a reason to enter. And it can be as simple as, you know what, I'm above here and I'm staying above here, let's go long. And we'll go through more of these setups over the next few weeks and months, but this is the basics of how I will swing trade. I will look for structural opportunities using things like unfinished business. I will look for a favorable condition and I'll look for a trigger to get in. Now, just to expand on the let's qualify trade away, and I want to be super clear on this, this particular unfinished business pattern, we're exhausting. 851 is less than 2811. Fewer aggressive buyers as price went up. Things are orderly. Here's an example of when unfinished business doesn't work that way, and it's what I like to call the trade away. So here we've got unfinished business at, well, we know it's the low. This is ES. This is our 8:30 candle. We can't even see the 9 o'clock one. It's somewhere up here. We broke the first hour low, the initial balance low. We traded down here with unfinished business on a down candle. This is quite easy to get drawn into, and we think, oh, we've got a target and really want an opportunity to trade towards it. But almost twice as much volume hit the bid at the low as it did one tick above it. So actually, we had some strong passive buying here. And that's classic at the extreme of the day as a way of saying, get away from here. So you need to be attuned to the subtleties of unfinished business, of when it's showing large passive trader interest and absorption. Don't adjust your thinking, adjust your bias. Don't get trapped into thinking, oh, I want to go back and trade towards this. So your bias is going to be wrong. And it takes a lot of time to getting it wrong to then get really good at seeing this. When you see this, it has to be regarded as a trade away sign. And we can see during this particular session, we never got back there to the low of the day, even though it was on a down candle. So always be assessing, are we exhausting? If we're not exhausting, we're going to go the other way. So I call this a trade away example within unfinished business. Now, in the last clinic, or 2 clinics ago, we looked at how I use zero prints as a sign of aggression, because a zero print is very absolute in the candlestick, whereas all imbalance percentages are arbitrary and therefore wrong. What I will do with zero prints when they occur intra-bar is look to enter in the direction that the zero print has formed, and ideally I'll try to front run them, and I tend to do that using automation. But something else I look at is I will look at zero prints on very long-term charts. So I'll look at them on 30 minutes. I'll also look at them on daily charts. Now here I've got all of this week. This is ES. To my mind, if we've got a whole day of trading in ES and we've got a price level where we never filled in the zero print gap during the day in a thick instrument like ES, that's really significant. And what is amazing with these prints is how they seem to hold over time. You can see this by wicks on the daily chart. And if we look intraday and look on our way back down here, we can see this one, we can see this complex of them here. Of course, on a daily chart, we're going to breach them. But as you look at faster and faster timeframes, you find these long-term zero print levels act as inflection points or stopping points intraday. And of course, they may well end up breaking, and that's why I have the indicator reversing the roll as we trade through them, and it's remembering them over multiple cycles of roll reversal. But I do pay attention to these levels long term because it's, well, we can do it two ways. We can look to quickly fade them intraday because they can act as inflection points, or what I like to do is be aware of them as potential stopping points on the way down. So if I happen to have got short on a structural trade here, I'm interested in what's below me, and I'll certainly consider taking a profit just ahead of the long-term zero print level, because it's extremely unlikely we're going to breach it and fly all the way through it intraday. We may well break it during the day, but not without a fight. So they are very interesting inflection points to be aware of, and how you play them depends on your trading style. You can scalp around them, you can fade them on the first visit, we can treat them as an exit point, we can be aware of them as an inflection point that's going to break, and then head away from them in the continuing direction. So if you don't look across longer contextual timeframes, I'd encourage you to do that. And even if your platform can't do this kind of thing, just tune your eye using a session footprint to look for a zero print in the body of the candle, draw out an extending ray and let it continue forever, and just monitor those levels. And likewise, if you have got them on a chart, zoom in on a shorter time frame and start to see what they do. Now, lots of these have been about sort of trading towards areas or reversals of price rejector, but it's not so much a pattern I look at, but it's how I read the volume in a footprint. I will look for things that tell me we are going to continue trading in the direction we're trading. So I will look for signs of continuation. It's the dog that doesn't bark because its owner is the criminal. So Now what I've done here is I've put up a 30-second chart to illustrate the process of the Open 5. Now I will scalp the Open just off a 30-minute footprint, which is no different to trading the building up volume in the dome, but I'm aggregating it in a footprint. So if I'm, for whatever reason, long, well, look at that, we've got a price rejector at the bottom of this. So we opened, we went down. There's a reason to be long during the open in the first 30 seconds. As we're on our way up here, I'm looking for reasons to stay long if I've had a good entry. And reasons to stay long will be, I don't have a zero at the top of the footprint. So if the auction has not finished, why on earth have I got a reason to get out on an upward rotation? If I don't see exhaustion, so if on the way up, let's say we're trading at this point, as I see more volume here, if I see 315 sitting above 266, I've got more buyers at higher prices. So that tells me we're not running out of demand. I'm going to stay long. I will look for a lack of absorption. I'm going to be paying attention to the deltas. I'm expecting to see positive delta at high prices, but I want to see significant positive delta. Here, I'm seeing a decent amount of aggressive volume being absorbed. The same thing here, these big positive deltas. If I see 40 contracts, 59 contracts, I don't really care. I know on ES that's not enough to stop us going in the direction I've got. So if I've got a good entry, sure, I'm going to throw my stop in above my entry because I don't want to turn a winner into a loser, but I'm looking to ride it for as long as I can. Now, this is only a 30-second chart. What's interesting here, though, is the same patterns play out in the order flow time and time again. We've gone up, so I've got a price rejector here at the bottom of the very first 30-second candle during the opening auction, and I'd have seen that even if I was trading a 30-minute candle. So I'd have been very happy to go along here. As we've auctioned up to the top, well, what will hopefully be apparent, if I crunch the volume together here, 464 plus 56 is what, 510, 520. I've got 520, 610, 340 at my 3 price levels at the top of the session. 1 minute in, 1.5 minutes in. I haven't exhausted. If I happen to have been long here, the top of this is giving me no reason to get out. So I can gauge after 1.5 minutes from the session footprints, or even if I want to look at this 30-second footprint, the bottom's pretty good. The top, okay, we've got some meaty absorption, but we haven't exhausted. So I figure that the bottom is in better order than the top, and I have a bias. Look what happens on our 4th 30-second trading period. I've got my price rejector again. I've got that happening over 5 price levels, 1, 2, 3, 4, 5, 358, down to 5. I've got the aggression here. I've got negative delta. I could treat this as trading a footprint on any time frame and think, well, okay, if I see this delta of, which is what, that's minus 150, minus 180, about minus 185. Once I get above here, well, 132 of that 185 immediately traded here, I can feel quite confident about getting long here to at least get back up here. Now, I don't scalp in this way off 30-second chart. I'm doing this all on the developing 30-minute footprints, which is no different to trading the dome. But you can reassure yourself on your reads of what's happening by looking within very shorter time frames and looking for these similar patterns that play out again and again. So we can really read the edges of the footprints to just assess, are we going to turn around? Looking at absorption, looking at price rejector patterns, or is the lack of exhaustion, the lack of absorption telling me that we're going to continue? So that really wraps up the things that I'm looking for within the footprint. It's time for me to hand over to Jeff, and we'll go through what he reads.
All right, oops, let me get my microphone. There we go. All right, great stuff. Really great stuff. Okay, I want to thank you, Lee. Yes, and Lee's not going away, guys. We're gonna do some Q&A stuff, and I'm gonna show a few things, and I want to bring up some points before I do that. First, I want to ask you a question, not at all from a marketing point of view, but from a useful tool point of view. The pullback that you mentioned, is that going to be a feature of your NT product, Lee?
Is the answer.
That's all right. That's okay.
Yeah. On initial release,
remains to be seen.
Yeah, on the initial release for our free footprints, almost certainly not, because it's really awkward. But it is on the to-do list. But our aim for an NT footprint is to offer something free. Now, there are commercial footprints out there. I know AMS, theirs does pull back. It's not a high development priority, but if it can be done relatively easily, then I'm happy to throw it in. But on the flip side, there are commercial footprints out there for Ninja that do it. Sierra has it built in. I don't particularly like reinventing the wheel on stuff that A is out there, B is only really applicable to more advanced traders anyway.
Gotcha. If you could, it doesn't have to be now, but could you maybe in the Anything Goes chat or whatever, you mentioned a couple of alternatives that do it, for the people on NT. I'm going to talk a little bit about what I'm doing and, my experience I've mentioned already with MZPAC, but we'll talk a little bit about that. But this is a space where, particularly for someone like me that's scalping, I don't marry tools at all. And if the tools are breaking or doing things wrong, like we had this week, with MZPAC, you really want to just eliminate that noise from your life when you're a trader. So if you could give us a few references on that, as well as, yours coming out, that would be awesome. I'd appreciate you posting. All right. So that was one thing. Let's see. I wonder, I'll give you some time to set it up. But I found that UB, as I've mentioned it many times, Unfinished Business, since you did that session, I kind of threw it in as a filter for my, kind of weight trades, particularly at the first hour high or low, where it occurred. And one of the things I noticed this week is basically on a 30-minute footprint, there was UB on every single candle. I mean, and it was every bar, and a lot of it was just because MZ-Pack wasn't working properly. But even once I fixed that, there was a lot of places where it just occurred back and forth. So, if you could bring up something at your end and maybe be prepared to comment on that, I'd be curious.
Yeah, sure. I'll get my platform ready now so we can screen share and discuss the past week.
Perfect. All right. So those were two things I wanted to mention on that. Thank you. And now let me talk a little bit about my David, you're not there yet. I'm just sorry. I just looked over to the questions. And I want to answer a couple of these first. And Lee and I have the same thing on this one, Darren. So I'm going to answer it first, and then if Lee wants to qualify it, I'll let him chime in here. But we are both discretionary traders, and what we do is we are both in the process, and the tools are just becoming useful now. We both have some and are in the process of developing execution bots that just take specific things and do them for us. But it is not automated trading. Make sure you understand that. It's discretionary trading. Go ahead.
Yeah, to speak to that, Darren's point, I am looking, well, I do like to have little scalping bots that will take 1 or 2 ticks based upon opportune, quick things in the order flow. So, if I can front run a 0 print on ES on a 4 range bar and get a tick, it's more likely than not to work. But I am not going to use that for directional, structural, or swing trading. It's something that is just opportune, and actually, here is something which is valid to backtest on a tick by tick basis, because what you're looking to optimize is where the stop should be, or what metric gets me out if it feels it's going wrong. So that is purely a bot doing something that I cannot do 24/7, and I can't even do it as a human quick enough in many cases. So we're exploiting aberrations, changes in liquidity, this kind of thing. Now, most of my discretionary trades are based upon TPO structure, and they're based upon the stats of how often does the second half hour trade to at least the edge of the first half hour. How often does the initial balance break on one side or both sides? When it breaks on 2 sides, how do we get back in there? So I'm using this as a set of guidelines on big picture probability. Here is a setup which, if executed well, or not even forget the execution, here is a pattern that plays out in the structure X% of times. And if it's more than 50% of times, naturally I'm interested. Then I need to look for reasons to get in. So a pattern like price rejector is a reason to get in. So I could just go, oh, if I see that pattern, I'll take the trade. Or I could say, if I see that pattern, I'll enter with a stop and let price take me in. But this is not particularly precise. Now, what I can't do that effectively is monitor how much delta is offside within the 3 or 5 price levels that are in the price rejector, and how's the pullback delta eroding that. And that's where little execution algos are really neat, because I can have the perfect entry trigger and I'll just press a button to say, now start looking for an entry, and it will get me in just as the delta ticks over. And that either means that the trade's going to work out quickly, or I've got the best chance of it not going offside, and I can be monitoring the delta and decide if I scratch the trade or get out with a small loss. So that's where I'm using the computer to help me do things. But on the flip side, this logic of if delta is 2x what the price rejector trapped delta is not a trading system on its own. I've tried it. And I can set this running on any permutation of chart types, or do I want double the delta or the same delta or half the delta? It will not work because I'm not taking any context into account. And that's no different to me trying to make a moving average crossover work or anything else. Just because we've got a favorable order flow pattern and we can recognize a trigger is not a good enough basis on its own to take a trade. We need some context and we need a structure, which is actually a setup. So you can automate little opportune things. It's very hard to automate your structural trading.
Okay, great answer. If not brief, excellent, and
and ninthly, yes.
Yes, that's one thing. Yeah, hey, you know, this is actually a really good point. This is segueing to a really good point. So first of all, David asks, can I give out price projector homework? No, David. So let me give everybody a really good example of how to learn with respect to this material. And here's the way that I suggest you do it at all of your stages, with a couple of exceptions for those of you that are much farther along, but you already know who you are. David, you're not one of them, so I'm just being clear. What you need to do is listen to a webinar like this and then just go watch the trade. And you need to do that back and forth for the next 18 months. Having exercises and whatnot, you don't know enough yet to do that. Just trust us when we say the way to learn this stuff is to hear it and then go look for it. But there's no extra, it's not school. There's no exercises that work there well, you know, like there are with the drills. We will give them to you when we get there. But you, and again, this is you, and I love it. You get ahead of yourself. Just stop and learn and listen. Pay attention to what we're talking about. Don't worry about how fast you can assimilate it. It will come. Okay. Can you answer Naresh's question, Lee, real quick before we go on here?
It's a double negative in there, so I don't know how to answer it. Yes, the screen
is that
grab,
a Sierra chart? Yeah.
Yeah. Yes. Every screen grab is from Sierra Chart.
Yes, Lee doesn't use anything besides that for charting. So, and I only use Ninja, and I have a couple of old TOS things that I throw up now and then. So that's it should be the default answer. And by the way, what Lee just explained was a really good example of thinking in bets. And as a trader, you should always be thinking about thinking in bets. You know what? As a human being, you should be thinking in bets because it's a good way to run your life. It keeps you on the right side of decisions. You know. At least gives you a fighting chance, if nothing else. Anyway, so let me go ahead and go on now into my chunk of this. And so I'm gonna mute you for a minute here, Lee. And okay, I wanna make a few comments about a couple of things. First of all, with respect to automation, what Lee said, I agree and I do, and I haven't shared any of that, and that's a 2021 topic really for literally all of you. Having said that, the ATM that I demonstrated in the live session this week, you know, the 4-tick one in NQ and the 1 and 2-tick one in ES is an example of a bot. You know, I'm hitting a market order when I think it's the right time. You know, and this is a screenshot, it's not live. So, but you know, whatever the trade is, I'm hitting that market order, and then it's immediately putting up a target for me, which in the case of the 1-tick drill is a tick, or 2 ticks, depending on which one I'm doing, or NQ, I use 4 ticks. But the point is, you know, that instantly sets me up to exit. Now, in my case, and this is a really critical point, that ATM does not, repeat, not manage risk for me. The stop it puts up is way off the trade by design for me, because I'm going to exit discretionarily if I make the bad entry. I'm going to watch, because when I used to do that like a rookie retail trader and use, oh, the stop's 3 ticks on the target, pick a number, it doesn't matter what the numbers are, invariably over time it wouldn't work, because I'd get stopped out right where it turned, and you just learn over time that that model doesn't work. You have to be reading the order flow. So what I do is, you know, my target is critical, just like what Lee said. You know, I have to have an idea what I expect from the trade, but stops are me saying, okay, Jeff, you're wrong. And the way to do that is this model again. Back here, this thing, okay? And so my perspective is very different than the way that Lee does it, even though we arrive at the same conclusions. Hang on, what am I looking for here? This thing, okay, so, and I brought this up a minute ago, I'll bring it up again. You know, whatever instrument I might be trading, and that varies throughout the day and time of day and the conditions, you know, I look at it and I say, okay, what's going on here? What do we have? You know, do we have ebb and flow? Do we have price discovery? Are we in HMOMO? I watch. There's no tool that tells me this. I'm just watching. Okay, I get what I'm seeing, and then I also let that order flow in the same sense that you see it here. You know, and I explained earlier, if I'm seeing a lot of selling in a price cluster that's an HVN, a high volume node, with a bunch of low volume nodes in the middle and another one, you know, I just know I can routinely make money buying here and selling here unless we leave the range aggressively, and you know, then it becomes different. So my approach is much more about this idea of going in with what is it I want to execute. Is there a real high quality, an ace king quality setup of that out there? And so when I go to the chart, what I'm looking for is that the chart is a tool. It's a measurement. I don't care what the VWAP is, and I don't care where this or that crossed, and I don't care that the EMA is at the 200, and I don't care if we have unfinished business, and I don't care if there's absorption or any of that stuff. What I'm looking for is the setup that I am trying to execute right now legitimate, and is it high quality? And that is my decision process. Okay, I've made it very simple. Now let me explain to you why I've done that. Number one, I trade a lot of size sometime. You know, not so much lately while I've been doing workshops and whatnot, but you know, there are days and real money, I trade 100 lots. So when you're trading 100 lots, you can't have an opinion. Not with my size net worth. You know, if you're trading 100 lot and you've got a $10 billion net worth, it's change in your pocket. But you know, if you're in my category, that's a lot of risk. So that's the point that becomes critical. It becomes about managing risk. So my approach, I over the last 47 years, is I taught myself not to think. So what Lee just went through was a really good example of analysis leading you to a conclusion, executing a trade. And that is the right way to do this for all of you. There's no exceptions to that. Now, once you understand that, you may progress sometimes to what Lee and I both do, and I almost exclusively do, which is this format right here. I say, okay, based on what I am seeing in this particular instrument right now for this time of day, knowing that the open is in 30 minutes, or you know, this is the open 5A, or that we're near a first hour low, or whatever it is, you know, I take all that into account, and then I say, okay, is there a setup here? Is there a trade here? If there is, where would I exit and be wrong? That's my concern. My entire model is about managing risk. And the reason is very simple. Profits are a given for me. You know, if I haven't been able to prove that to you again, this is not about me, you know, patting myself on the back and telling you how great a trader I am. You know, just look on the stuff on Surfing the Market or in the TRG. You know, the results are there. I can do this all day long at 80 or 90%. You know, it just works, okay? So for me, the only thing I can do wrong is think too much and just overanalyze and let the market, not let the market tell me what to do and try to tell myself what to do. Because the minute I do that, I start making mistakes. So that's the context that I'm going to talk about how I use footprint charts. Okay, so let's see. So let's do this. I'm going to go over here and show you my left-hand screen. So it should be that one. Okay, can you guys, let's see, that's not, can you guys see that okay now? You should be seeing my left monitor and my crosshairs moving around on it. Yes, no, yes. Okay, cool. All right, so, and again, I put the LRCs back on here and I'll kind of explain those as I have examples, but today's about footprints. And so let's kind of stay in the footprint mode for someone like me. So up here, I'm simply looking at the movement. This is my 15-second view. And again, remember, you know, my point of view, this entire screen is portrait and it's on my left side, okay? And if I'm trading gold and oil, they'll be portrait on my right side. So that's what I have on my periphery. And in the middle, I'm seeing all the domes. So let's say I'm watching the domes and I'm thinking, you know, gosh, this looks like a this or a that. Then the next thing I'm gonna do is I'm gonna just glance left and see if that situation is confirmable. So for example, let's just pop this up. Okay, is there any way you could define this movement right here as anything but an HMOMO long? No, not possible. And you know, that's what happened at the close, right? So if I'm seeing that and my notion over on the dome was that there's a long, that's all I need to know. The footprints, I don't need that information anymore because you know, you get it, right? So if I put up my my index domes over here, and I'll come back to that. But so you know, just so from your point of view, remember this is what I'm looking at over on the right, and so I'd be seeing that energy on the dome. And the only thing I might want to do to keep myself out of risk trouble, again, I'm managing risk, that's all I'm thinking about, is I just want to make sure there's nothing on a footprint that might be much more informative. like, well, you're doing this, Jeff, you're buying, but you're buying into a high that, like Lee just demonstrated, has been sold for 30-minute blocks all day. That would be a really bad mistake. That would be called being on the wrong side of the trade. So let's see, if maybe the footprint can help me avoid that problem. Okay, so let's look at ES again, and this is a 45-second footprint. And again, you can see, well, in the context of what we just saw there on this, basically what that did is that's all the consolidation there. So that move is really over. And if you pop out the footprint, you can kind of see that, wow, that move is actually over, isn't it? But if you scroll back a bit, you can see where that move was going on pretty strongly. It was pretty obvious. So this type of chart for me is really only to kind of confirm what I'm seeing, because, remember, the reality is I've got a footprint over here on the dome that's more or less doing the same thing. So when does this become valuable for me over here? Well, that 30-minute example I just gave you. What if this isn't a good example here, but let's scroll back a bit. Okay. What if, we were coming up aggressively into a whole bunch of 30-minute footprints that look like this? And, and I'm thinking, well, maybe there's a long, like right in here. This kind of behavior might convince me that maybe that's not such a good idea. Simply because, obviously this area got sold with a little bit of overshot, And so that's an example of where I will use footprints that zoom out a bit to just kind of confirm, that I'm not just making a really colossal mistake. And again, it's about managing risk. Now, how else do I use these? A couple of other interesting ways. So while we're talking about that, let me do this. I'm gonna switch screens. Give me a second. It's the case of the amazing disappearing Zoom toolbar. All right, let's put this back here. Okay, just to check, are you guys back on my main screen and you now are seeing a footprint chart of 10 minutes ES? Yes, no, maybe, yes. Okay, no, wait, that's an old yes. Can I get a new yes? Cool, all right. So what I did here was, one of the things that I do like about MZPAC and is that it has this ability to do a couple of things I like all at once. Like, so these are imbalances, these little dots, and and as I compress it, it just leaves the dots. And so this was that area where we had a nice trend down into a turn. And this particular example of it was during the overnight, but it doesn't matter when they are for me. I will filter it by, oh wow, that was the first hour low too. That's even better. But whenever I see this kind of a pattern on a longer term footprint, I wake up and I say, okay, let's look at this right down here, Jeff. I talk to myself, negative delta, negative delta, negative delta, negative delta. I mean, these are just up thrust after up thrust on a 10-minute chart. And then all of a sudden that stops. Hello, all right, if you're short, you cover and you're done. Now, is this a long? Is it a reversal? Gosh, it sure looks like it to me. Just look at that. That's my delta right there. And just look at that delta against, this trend. It's really a big change. And, this is 10 minutes, obviously, but clearly, some sort of a turn happened here. So that's what I use the longer term footprints for, just to kind of keep myself on the right side of larger moves, understanding that, for me, everything is a scalp and I'm always scalping. So, so I like to let the footprints that I'm seeing here, these ones on the dome, and like, again, that example here where high volume node getting sold, low volume in the middle, high volume node getting bought, that's where, scalps, trade's always a scalp, good trades prove it right away. So, I might nibble in long right there. I might even front run it. If we're trading 52.75, I might put a market long on there. What the heck? And then I'm looking over here, and again, I can't show you this live until we get some live action. Next week, I will do that. But, if the blocks over here are on my side, or just the overall delta trend, 15 seconds in this one, 2 minutes in this one, if those are heading my direction, then I'm going to say, all right, I'm on the right side of the trade. I nibbled in. I might get lucky and catch a reversal here, and then I'll add to it. If not, I got a nice scalp, and I'll scalp it and take profits. So that's kind of my point of view. Now, 5 minutes is generally what I use for that, and this is a much better example. Now you can see what I was talking about. Well, just that one at the close. It's really obvious, when that happened. This is consolidation. This is ebb and flow. Okay, this entire block, and then all of a sudden that behavior changed. So this is Doc's approach. Lee has a very analytical approach. That was mine 10 years ago when my brain was younger and I could fit more stuff into it. And, you know, now I'm old and it's like, Jeff, think less. Just let the market tell you what's going on. Consolidation ended and we are going up. Get long and hold on for the ride. I have no target. I will exit when I think the move's over. And that's that, you know? So I'm constantly looking for changes in personality. And for that, I will use a 5-minute, Jerry, and they're actually useful, but I'm not looking at them for trading signals. I'm looking at them to confirm that the scalp trading signal that I'm using or not using was correct. And so that's a couple of examples for me on longer frame. And down here, this is useful, the stuff down here, the metrics, but most of the time I don't have time to read that. And one of the things I find about footprints is if I stare at them, often the trade is over by the time I get back to the dome because, you know, they happen quickly. So with that in mind, hang on, this one actually doesn't go on the left side, it stays here. Let's take a look at one of these really fast ones, like a 45-second. And I can show you some other patterns that I like. I'm a scalper primarily, and let me qualify that. For me, I go in with this methodology that I've shown you a few times here, but let's pull it up again, all right? I spend 5 minutes or so or a couple of minutes looking at the context and say, okay, what side of the tape do I want to be on? What's going on here? And once I've got a sense for that, I'm looking for an intraday swing in the back of my head and looking for quality, but, I want to make some money, so I'm going to scalp. So I say to myself, where is that context that I just decided? Where is that wrong? And is this the third time I've made the same decision in a row? That's item number 5. Then I'm probably not sane right now and I need to go do something else and not trade. And then after that, it's about execution and risk management and nothing else. So, with that in mind, take a look at that trade that we were just talking about where, you could have got long, but let's look at the 45-second version of it, okay? And, let's get in and look at the detail. So, literally we were consolidating here and there's so little action, I can't even get the chart to display it. I mean, that's how little was going on here, very small deltas, not a lot of, it doesn't, this is one of the things that's wrong with MZPAC. It doesn't rescale properly, but basically you can see this consolidation was going on for a while. And remember what I said about, you're looking for personality changes. What does that look like? It's usually pretty obvious if you're watching a very fast footprint. And if you're watching the dome, it's immediately obvious. Okay, let's see. You see anything different? Okay. And again, the delta here would be really deceptive because it was negative on that big chunk up there right at the close. And that was when that Fed announcement came out. Look at all these, people, it just shot up. And so again, whenever there's a change like that on a very fast chart, it just grabs my attention. And so that's the way that I use footprints to scalp. And typically during the day, I run these on 15 seconds. But MZPAC hasn't been able to handle that. So let me switch back over here and hang on 1 second, guys. Okay, sorry. Anyway, so let's see, let's put it back to that screen. And so the beauty of having this arrangement, are you guys back on my left monitor now? Yes, Jerry, that's exactly what it is. And that's why I love it, because I see it happening. I just hit a market order. And, I might do it for, look, this is where the setup is so critical to sizing. If I see that, what is the most likely thing in the very short term? A 1 tick drill is a no-brainer, right? So I might be able to get, 30 ticks, or I might be able to ride a really nice move. I know that a 1 ticker, a 2 ticker, a 3 tick trade is no brainer. So instead of trying to put on a 1 lot in that circumstance, I'll jump out and put on 5 or 10 for 1 or 2 ticks, and pick up a couple $100 just like that. Again, it's about managing risk. A move like that often ends as fast as it starts. So, again, what did I say a minute ago? As I've gotten older, I just like to think less. It's easy to grab that with a quick tape scalp and just accumulate profits. Whereas, you know, I can also go the other way. I can say, well, you know, that's the first hour low and it's only 7:30. So this could go all day. So, you know, we'll buy a couple and we'll see if it gets going. And if it does, we'll buy a couple more. And, you know, so that's exactly what I mean when I'm doing this. You know, what's the context? You know, where are we in context to the rest of the market? And, you know, so what makes sense to do here? And another way to look at that is this concept. And again, this is a critical piece of what I do. Understand the technical picture, that's the big picture. Understand the current auction structure, that's the footprint chart you're looking at. And the order flow is the kind of granularity within that auction structure. You know, are there a bunch of trapped guys at the bottom like you saw in that reversal? Or, you know, what just happened in the very, very short term auction structure that as an order flow trader you can capitalize on with no risk. So, so that's what that's about. And anyway, so let's see, again, we're back on the left screen, right? Just checking that, yes, no, maybe? I'm sorry, I can't tell from Zoom. Yeah, okay. So if you blend these three elements together and you look at that kind of big picture of what's going on during the day, where's the first hour high, where's the first hour low, and then, you know, are there any opportunities, just, are there a bunch of guys off sides at any given moment? You'll see it on a fast footprint. I usually I try to get as close to that as I can. You know, 30 seconds is often a good number for these two. So tell you what, I'll switch them both to that while we're talking. And then again, up here, you know, the linear regression, if you're still, you know, using that, or if you haven't used it yet, you want to understand how that's helpful, that will just give you an idea of the really short-term range within the range. So again, you know, in the case of what I'm seeing right here on linear regression, it would tell me that, you know, we had this big move up, but that moves over, and now we're consolidating. And in fact, you know, if I'm just thinking purely in statistics, you know, we're at the bottom of that consolidation, you know, and obviously we just closed, so that makes some sense. But, you know, that's what the purpose of that is. It's not to give me a trend or any kind of trade signals, but again, just to kind of evaluate mechanically for me what I'm seeing. So you know, there's an example of 30-second, and you know, that's one of the things I said to one of the guys in the chat room during the week was, you know, really all I'm looking for on a really fast footprint like that is the transition from one bar to the other, you know, consolidation, breakdown, you know, consolidating again, and look where this was right there, you know, if that was right at the bottom of that. So, you know, that's worth paying attention. And, you know, you can see these kind of patterns over and over again. You know, it'll break, pull back, you know, right back to that same level. So this is a lot of the same stuff Lee was talking about. It's just on a much faster time frame. But yeah, the order flow concepts are exactly the same. There's nothing different. You know, the patterns don't change, just, you know, how they play out does. All right, so, you know, that's kind of a scalper's view on that stuff. And so let me just review really quickly. From my perspective, I like to let the IPs tell me where they are. So, you know, like just on these two, you know, this was one down here, you know, selling stopped and buyers came in and then we went up, you know. So from this moment right here, you know, the only thing I should really be considering, you know, unless it's a bounce off of a really, really strong trend, you know, I should be getting long or getting out of a short, you know, anything else, you know, I'm making a risk mistake. So again, you know, repeating that, it's always about risk. And for me, I want to stay in the fastest time frames I can stay in, but I want to respect the longer time frames, just again to keep myself from making stupid mistakes. You know, like again, this 30-minute pattern right here. You know, this, if you're watching this and we're down here somewhere, you know, and we do that one, and then it comes back down here, and then we do that. You know, if this is happening, this is a long or nothing. You know, there's you can scalp short in here, but clearly, you know, something's going on here, and you need to be mindful of that. So that's all. Anyway, let's see. That's probably all I've got for you. Let's see what questions you guys have, and we'll go from there. So, go ahead and let me have some questions about any of my stuff, and we'll see if there's further detail I can show you guys. No questions. All right, well, that's easy. Lee, you want to chime in on any of this stuff? I don't know if it's relevant to you, but
I yeah, what struck me, Jeff, is we're doing very similar things. We're describing it slightly differently because we're both getting into this flow state. We're both looking at context, and what stands out to me is that because I don't want to sit at the screen spending time getting drawn in, I'm looking at the structural swing analytical type trades, and the only time I'll scalp's at the open. You're doing the same analysis because I'll look at a footprint chart or a 30-minute chart or whatever and go, okay, I know where we are on the day. But you're taking that framework of where we are and you're thinking, well, if I'm in front of the screen, I might as well scalp. And I think that's the one difference, that screen time for you, you're happy to start clicking and scalping because it's a return on time spent. I will actually choose not to spend that time doing it other than at certain times of the day.
that's a great example. And a lot of this, again, is just, what's your Bubba and what's your personality?
Yeah.
It really is. Remember this, I've got this running on my desktop all the time. And this is the one that's up when I'm not doing anything else, just to be clear, this dome, so I can see all the markets. And I can't tell you how often y'all come back this week. This must have happened 3 or 4 times. Y'all come back from a run or going down the beach or, walking one of the dogs or something. And I literally just walk by and I'll say, oh, wow, there's this, and I'll click and I'll grab a 1 or 2 tick. And, for me, it's either that or, in the morning, I'll sit down and I'll say, okay, you got to make this time productive. And my measurement's $1,000 an hour. If I can scalp $1,000 an hour, it's worth the time. So, for everybody, that's different. Let's see, Felipe. Yeah, I don't know if you were here earlier about MZ. MZPAC has some issues right now that are half market volatility, half stubborn owner of the company who's a very good programmer, but, believes that the users are stupid and that everyone should just do it the way he wants to do it, which, is unfortunate. For example, right now, I asked Lee about unfinished business on, on his footprints. Right now, MZPAC is showing unfinished business literally on every 30-minute bar. Top and bottom. And the reason it's doing that is because to get it to paint properly, you've got to consolidate the levels. So you're not seeing a reconstructed tape. You're seeing, a consolidated tape, which, guess what? For order flow is basically useless. But for some reason, I couldn't convince Mikhail of that point during the week. So, I posted in the group. It's here in the MZPAC channel. These templates that I put up avoid that issue because they don't use anything that's having it, but but they are useful primarily for short term right now. And we'll work that out as he fixes his issue, or we have other recommendations. Lee's going to post some suggestions. Look, for me, it's about the right tools. I don't really care whose tool it is. That's really the short and long answer. So does that help, Felipe? I hope. Okay, Darren, Lee, could you answer this one?
Yeah, so I want to do something more dynamic. Yeah, so what I could look at doing, challenging next week, so I'm traveling middle of next week, but I probably the right way to do this, because I'm looking at 2 or 3 very structural setups. If we run a live session around particular times of the day, so central like 9 to 9:30 or after 9:30, there's no guarantee on a given day that we're going to see that setup. So we've then got a wasted session going on. But what I'm happy to play with in a couple of weeks' time, I'm certainly thinking about this. I could probably record a screen of just a 30-minute footprint, which would show the orders coming in from my main trading machine. And I'll just do commentary as I'm trading my 2 or 3 time of day setups. And if we so happen to have a good setup and I've traded it right, then I can share it in Slack, and this can form the basis of one of the deep dive clinics as well.
Cool. Awesome. Great stuff, Lee. All right. So what I was just doing here while you were doing that, because I just want to show an example, another one of my examples. I'm literally just moving around on this 30-second footprint and just randomly finding spots. And so I'm just going to scroll along here and just watch this. And whoops, and the trouble is it doesn't format very well. But there's a few places, again, where you can just, let's see, if we do it this way, I want to show you a couple of other examples, but I don't think I'm going to be able to do it on this particular one. So yeah, there's a couple of them there. But I mean, literally, if you just kind of do what I'm doing, guys, and just look for like that's the one we were talking about earlier, but it's really obvious what happened there. Um, let's scroll back. Yeah, and like here's a breakdown event. And I have no idea what was going on here, but boom, boom, attempt to go up, boom, attempt to go, boom, 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 boom. So when you're seeing this kind of thing, you can just dive right in and work with that environment, on whatever interval you're on, and this footprint's just not allowing me to demonstrate it to you as the way I want, not in those, that time of the day. So if I just look at it here, you can see it. I mean, just forget what time of the day it is. When you see this kind of behavior that comes crashing down into, what clearly is a high volume turn, at least in this time frame, if you're watching it and you got nothing to lose by nibbling here and saying, all right, a long is a really high reward, low risk trade. You're wrong if it's here and you just let it go as long as it goes. So that's another example of how I literally use no context whatsoever. And I'll just watch the footprint for that pattern. And given our session today that this is about patterns, I wanted to share that one. But those are really the only two I have. I mean, I try to do a lot less thinking. But part of that, I need to qualify that. A lot of that is that it's just already burned into my head. A lot of the stuff you're seeing from Lee, and that's why that's such good material for the rest of you guys. But remember, my point of view as a scalper, and yours should be the same. Number one, I assume I have the skills to be profitable. Otherwise, I have no business being a scalper. Number two, that by definition is that if I can scalp 85% and my skills are that I'm profitable, then profits are a given. Okay, listen carefully. Profits are a given. The thing I'm concerned with is managing risk. So I don't use targets. I don't use stops. If the entry I made to the trade is not going anymore, I mean, if I entered that trade thinking I'm going to get a tick and it's 2 or 3 ticks away and accelerating, I'm gone. I don't have a stop. If I'm doing a 1-tick drill and it backed off 2 or 3 and nobody else is selling, I'm going to add to that. And, now I'm going for 3 ticks with the same thing, except I might have doubled it. So I've actually lowered my risk and I've added my reward in that circumstance. But could I give you a mechanical way to make that decision real time on the fly? No. It's a matter of understanding, what type of price action we have, ebb and flow versus price discovery versus whatever, versus high Momo versus sometimes there's really nothing. Sometimes it's all 3 combined and, just stay away, which is kind of what we had at times, this week. So anyway, that's really what it's about for me. Find good opportunities, good trades, work right away, manage risk, and use the footprint to confirm an idea that you already had. If I'm looking at the footprint for ideas, it's going to be too late. By the time I get back over the dome and think about execution, the trade's already happened for me. Okay, so questions, comments for either of us, any, either part, Lee's part, my part, both. To your point on risk and profits are given, my best days are now looking more like your normal good days, but my bad days are, okay, well, that's really simple. You're just not managing risk well enough, and that's because you're new, and that will take time. But you're on, that tells me you're on the right track, because that's where I was when I was learning. And by the way, that's true in any setup, testing, training, and practice, is that if it works like, if the trend is that good days are getting better and best days are getting better, as long as bad days are improving, they don't necessarily be high quality, but that means you have a workable edge. Do you understand what I just said? That's a very key point. Would you agree with what I just said, Lee?
Yeah, and I think the sticking point for a lot of people is recognizing when you're wrong, admitting to yourself that you're wrong, and acting on it quickly.
Awesome, exactly. And if you watch me in any of the live sessions where I have had a losing trade, watch how I do that. I will literally just, that's not working, and it's over. I just go over and I hit flat for that. I mean, I don't think about, is there a good place to exit? Maybe the chart, footprint chart will tell me that, no, it is still a good, no, none of that nonsense. It works right away. If it's not working, your judgment should be a blink, and over time your blinks get better. But stop thinking, everybody. You can't think fast enough, in depth enough, You know, what you can do is what Lee demonstrated, where you look at an area and you say, okay, this is a really good idea here based on the bets and the odds of the moment. And then you either do it or you don't, and you manage it if you did it. From a point of view of, you know, Lee and I both agree that when trades are wrong, they pretty much explain that to you for you, you know. When your thesis stops working, the trade's over. It's that simple. You know?
If you're hoping and waiting for it to work, you've got your answer.
Exactly. And that's why the Furu, you know, let your trades work could not be further than the truth. It is such nonsense. Letting your trades work is Furu speak for you had a really shitty entry or the setup doesn't work at all, but if you give it long enough, everything works. So for example, if I put up a Furu channel, and I've actually done this, I did this in 2010. I put up a Twitter, and the only thing in that Twitter I did was I averaged into a moving average crossover with size. I had 100% winners. You know why? Because that will always work. It's math. If I average in to a change in the trend, just think about this, guys, I will always be wrong, right? The question is, how much do I have to lose to get there?
Yeah.
And
if you can trade with size, you can be so loose. But the point is you don't get to trade with size until you can trade without size.
Exactly. Exactly. You know, and so for those of you that are watching me doing, you know, how's he making $90,000 in the, you know, the leaderboard? Well, that's what I'm doing. You know, when it gets to extremes, I'm nibbling. And then when I'm right, I'm sizing up dramatically. And, you know, could I do that in my real account? Yes. I could do the kind of trading I'm doing, but a good chunk of it is sim that you're seeing in those numbers. But, you know, 5 figures of it isn't. And what I mean by that, you know, but I've got the skills to get there. And I'll tell you this much, as far as order flow, in 2015, you know, 5 short years ago, I could not do that. And I was you, Darren. You know, I'd have great days and I'd say, God, this stuff is awesome. You know, and then I'd lose $1,000 in 15 minutes and I'd say, God, what did I do wrong? And the answer was always the same. I thought too much. I mean, I reverted to my chart brain and I got stuck with a price level. And I've watched all of you do that. Naresh, you're here. I'm going to pick on you again in good humor, but that's what you were doing. That's exactly what you were doing. You were saying, well, I've got these price levels on. You can't do that. There's no indicator that's going to give you good information about that. You know, what Lee showed you with his old you know, inflection points that go way back based on zero prints and whatnot. That's, again, a really cool way to look for places where there might be a turn. But the mistake that most of you make is that you assume there will be a turn, and that's the danger. You know, Lee doesn't do that. He just says, oh, that the odds are good there, not, oh, that's a price level I like. You know, right?
And in fact, what I will do, because I'm generally trading towards somewhere, I'm using it as a point to get out, because I don't want to get caught up in what might be happening there. If I've happened to get a good entry for some reason, this allows me to extend the trade to, I like to think of it as a stopping point. So I've got a certainty that, well, you know, we're going to explore there. And this is my approach on big liquidity in the book and whatever else. Because the inflection points are magnets, and we can call them high volume nodes, lovely. I don't care what we call them. But if we can identify a level where activity is going to take place, or a battle's going to take place and it's uncertainty, if we can be trading towards that, it's a beautiful exit point.
Totally agree. Totally agree. Sorry, I was scrolling by. I don't know if you're seeing my Twitter. I think you guys are. Somebody said something about shoulda, coulda, and woulda, and I responded. And I just wanted to share it with all you guys. Sorry, that kind of came up in the middle of that answer, but I can't find it right now. But somebody basically said I was doing XYZ trade and I should have done this or that, and my response was to eliminate 3 words from your trader's vocabulary: shoulda, coulda, and woulda. So, yeah, absolutely. Great thinking, great comment back there, Maria on Hope. Great comment, Lee. Okay, so Darren, discerning untradeable price discovery is another way. Yeah, it is, you know, and that's just seed time. Yeah, there's even times where I will say to myself, you know, this is part of the play aspect. I will say to myself, this is price discovery, you know, and I'll go into my one lot account with a micro maybe, and I'll say, maybe I can figure out some good little bots for price discovery, and I'll play. And actually, Lee and I have kicked around some ideas for some of those little bots, because there are patterns. You know, you just have to think differently. David, webinar on that topic will help. Take a step back and absorb the stuff you already know and stop asking for more topics.
Practice.
I love your youthful enthusiasm, but yes, Lee just nailed it. Practice. And Naresh, I love your comment a couple of lines back that, where you were doing that before and now you're doing, looking at the order flow. That's awesome. I watched you make that transition. Now you just need to keep focused on it. Oftentimes people revert under pressure to their old ways. And that's part of the value of the group is, somebody will make a comment like that and we'll come down on them like a ton of bricks. I can tell you I can guess probably for a fact, but I can certainly guess with pretty high probability that no one's going to mention dark pools anywhere on our chat anymore. And, and that's good. It's not that. Let's see, Jack's. Yeah, Jack's here. Okay, so you guys get the point. All right, any other questions or comments? This has been a good long session. We've had, gosh, this is going into 3 hours. It's going to be one heck of a recording. Any other questions? Any other comments? Anybody with a burning desire? My always last call. And that means you don't have to ask a question. You can even say, I was such a moron last week. I lost $11,000 and this week I'm not going to do it again and I'm being accountable. That is a burning desire you may post in the chat. That's what that means. We are just being supportive of one another. All right, with that, I thank you, Darren. I think it was an excellent one. Lee, if you want to sign off, we'll call it a day.
Yeah, good. Thank you, everybody. And looking forward to doing more of these, and we'll see you soon.